All right. Hello to those. Please ignore all the tech talk that we just had. But thank you so much for everyone who's joined us right on time. My name is Nazia Hussain. I'm the product manager at the Institute of Sustainability Studies. Thank you so much for joining us for yet another Sustainable Action Dialogue series webinar. The series is a platform where we bring you leading experts who distill the jargon that is often associated with sustainability topics, and we hold focused discussions on content that can really help businesses and individuals realign commitment with action. And today, I am delighted to have all of you present for an exclusive webinar on Scope 3 emissions. What are they and how do you calculate them? It's being delivered by Gráinne. Gráinne is a sustainability professional with many years of experience in the field. She's currently driving sustainability within Homestore and More, which is Ireland's largest homewares retailer. And in her previous role with Goodbody Clearstream, she guided a number of clients from corporates and SMEs with their climate strategy. She holds a first class honors in BSc Environmental Science and Technology from Dublin City University. And I'm delighted to have her here today. Before I invite Rania to deliver today's session, I'd just like to request everyone that you can use the comment section that you can see on the LinkedIn Live to drop any comments, any insights that you have on this subject, or any questions that you may have once we progress through the slides. And there'll be enough time for Q&A towards the end. All right, so over to you there, Grania.
Perfect. Thank you so much. Yeah, welcome everyone. Delighted to be here today. I was going to start with a quick intro, but I think that was a good intro just on who I am and what we're doing here. But yeah, today I'm going to talk about Scope 3 emissions. So climate change is increasingly one of the most important sustainability topics that's coming on the agenda, particularly environmental sustainability. And within trying to measure and tackle climate change emissions, Scope 3 emissions can be a bit of a challenge and a bit of a mystery for a lot of companies as well. So hopefully today we're going to touch on just what they are and then maybe go into a bit more detail on how you actually calculate them, the challenges within that as well. And these are the learning outcomes just for the session today. So firstly, just understanding Scope 3 emissions and the 15 different categories within Scope 3. So we'll go through them and all of them individually. Which are the categories that are typically the biggest impact per sector and the most difficult to calculate, what methods are available to calculate Scope 3 emissions, and expectations with Scope 3 emissions for your CSRD reporting. Typical challenges companies face and how to overcome these, and how companies deal with Scope 3 emissions in emission reduction targets as well. So we'll touch on that, but it can be slightly different from your Scope 1, Scope 2 emissions there. Okay, so firstly, just level setting it for anyone who hasn't heard of Scope 3. So what is Scope 3? So when you're calculating organizational emissions, your emissions typically fall into 3 different categories or scopes. So your Scope 1 and Scope 2 emissions is emissions within your direct control. So Scope 1 emissions is any emissions due to activities of the business. So that tends to be maybe fossil fuel combustion, maybe leaked greenhouse gases. So things like diesel in your company vehicles, natural gas for heating would be within your Scope 1. Scope 2 emissions then is any indirect emission due to electricity that you purchase. In Ireland, it's primarily electricity that you purchase. In other countries, that can be a bit broader to district heating as well. But Scope 1, Scope 2 is very much so within the control of the company a lot of the time. So it's within your operational control. Your Scope 3 emissions then is any other indirect emissions due to activities of the business. And that could be really, really broad scope. So a few examples here, like say, for example, business travel. You're obviously not the one who owns that plane. You're not the one who's burning the fuel within the plane to send your employee to somewhere abroad, but that flight, you are purchasing a flight for your employee to go to that, whatever it may be, that business activity abroad. So it's kind of happening indirectly as a result of your company, even if you're not the one who owns the plane and who's burning fuel in the plane. So Scope 3 is very, very broad. It covers 15 different categories, which we'll go through each of them and what they mean. But yeah, it can typically be the biggest challenge for companies because it's not within your direct control. It can be harder to get a handle on that and to be able to get data on your Scope 3 emissions. And one thing to say as well is that for scope 1, scope 2, if we look at the standards for carbon footprinting, which are the greenhouse gas protocol is the main one, and then there's the ISO 14064-1 as well, which is based on the greenhouse gas protocol. So they're kind of one and the same. Scope 1, scope 2, it's mandatory to collect absolutely everything in your scope 1, scope 2. Scope 3 has a little bit more flexibility within it as well, but we'll see that increasingly with reporting requirements, it is becoming kind of it is becoming quite standard to try capture all of your scope 3 emissions, whereas previously it was more so at the discretion of a company. But we'll talk a bit more about that later on in the webinar. So why is scope 3 important? So for a lot of companies, scope 3 is where most of your impact is. So this is an example of Microsoft's carbon footprint. And you can see here, hold on, I get the pointer. Their scope 1 emissions is only 1% of their overall footprint, and scope 2 is only 2% of their overall footprint. So really the emissions that are within their direct operational control are quite small in comparison to their scope 3 emissions, which is almost 97% of their overall footprint. And that breaks down into a few different categories. So you can see that the actual goods that they purchase to manufacture their goods is quite a large portion of their emissions, as well as their capital goods. So the things that they buy basically are a huge portion of their emissions. And this isn't uncommon for companies. So a lot of companies will find themselves in the space where scope 3 is kind of the biggest impact of their emissions. And this is just an example of per sector where scope 3 emissions tends to be the highest. So for example, if we're looking up here for financial services, so scope 3 is almost 100% of financial services emissions. Because if you think of it this way, your scope 1, scope 2 emissions is really just a few office energy emissions compared to all of the companies that you're financing, all of maybe the mortgages you have, all of the energy associated with those homes. So it's the building of your offices multiplied by millions possibly, and then more carbon intensive activities as well. So office activities, they're not too carbon intensive, but you could be invested in a manufacturing company, you could be invested in an energy company as well. So your scope 1, scope 2 gets kind of dwarfed in that scenario. Compared to other other sectors that are maybe a bit more scope 1, scope 2 intensive. So for example, cement, the process of making cement is a very, very carbon intensive process. One, because you're inputting a lot of energy into that process in the first place. So you could be burning a lot of fuel to do that. And then second one is just there's a natural when you decalcinate cement, CO2 is released from that process as well. So it's quite a carbon intensive process. So the scope 1 of that and scope 2 is a lot heavier than other activities. But you can see, for example, how someone else's scope 1 can impact someone else's scope 3. So if you're in construction, chances are you buy a lot of cement. Cement, as you can see, their scope 1, scope 2 is quite carbon intensive. That will mean that your scope 3 is carbon intensive as well, because you're purchasing a material that's very carbon intensive to do your business. So your purchase goods emissions are going to be quite higher. So you can see here different organizations or different sectors and their carbon intensity. See, for construction here, for example, as I was saying there, so your scope 1, scope 2 is quite small in compared to your scope 3, where you're purchasing all of that steel and cement, which is quite carbon intensive down here. But yeah. Okay, so I'm going to go through the different scope 3 categories here one by one. So this might take a minute for me to go through them, and feel free to pop into the Q&A box or the comment box any questions you might have on some of them as well. So you have upstream scope 3 emissions. So firstly, in your upstream scope 3 emissions, and this is a really important one to talk about, is your purchase goods and services. So what this means is this is all of the cradle to gate emissions for any goods that you purchase. So for example, if you're purchasing steel, it's all the emissions to extract that raw material, process it, manufacture it into a steel product up until it reaches the gate of your organization. So if you're a construction company, you have to account for all of that upstream emissions for that product that you buy. And typically purchase goods and services for a lot of companies is very broad, and it's one of the most complicated ones to tackle, basically. But it can be quite large for organizations as well. Say, for example, if you're a retailer, purchase goods and services probably your biggest impact from everything that you buy. But yeah, purchase goods is quite a heavy one. But we'll be talking about different methods to calculate scope 3, and we can talk about that one in a bit more detail. Capital goods then is very similar to purchase goods and services. So it's all of the upstream emissions for all the capital goods that you buy. But capital goods tends to be capital equipment. So maybe purchase goods is something that's kind of consumed or used within a short period of time. Capital goods is maybe more capital investment. So that could be equipment or machinery maybe that you need for your sites. But it could also be something like if you're building a building, that's going to be there for years and years within the company, but it's a new building that you're building. It's all of the emissions associated with building that new building as well. So capital goods can be a tricky one just because it fluctuates so much from year to year, whereas purchase goods and services might be consistent enough, and it probably grows with the growth of your business as well. Capital goods can be, well, we built that building 3 years ago, we haven't built anything since. So it can be a bit, capital goods can fluctuate a bit more, I would say. The third category then is other fuel and energy related activities not included within scope 1 or scope 2. So this one can be a little bit complicated for companies to get their head around, because scope 1 and scope 2 is where you really think of your energy emissions being. This category though is really talking about indirect emissions from your fuel and energy related activities. So for example, if you're buying diesel in your scope 1, you're accounting for the emissions of combusting those liters of diesel within the vehicle. In this category here, what you're accounting for is the emissions it took to get that diesel to the tank. So the emissions it took to extract that oil and process it and get it into diesel form and get it up to the gas station before you bought it. So it can be difficult for companies to get their head around. One thing I will say is that it doesn't tend to be a very material category unless you're a very heavy fuel and energy user in your scope 1 and scope 2. But say, for example, if you're a retail or a construction or something like that, it's probably not going to be huge unless you're electricity generator or something along those lines. Upstream transportation distribution. So this is the emissions associated with transporting your goods to gate, basically. So if you have a third party doing that, that's accounted there. Waste emissions. So this is the emissions associated with processing the waste once it leaves you. So is it the waste within your operation? So is it going to recycling? Is it going to landfill? What's the emissions associated with both of those? Business travel emissions is probably quite self-explanatory. So it's the travel emissions associated with sending your employees on business travel. So if they're getting flights, if they're getting taxis, what's the emissions associated with that? Also included within that category is if an employee is traveling in their own vehicle, but you're paying them back mileage. So you don't own the vehicle as a company, but you're kind of paying them back for that. That would be included within there as well. Employee commuting then. So that would be your employees coming to and from the office every day, or however many days they do if they're hybrid working. How do they get to the office, basically? How far are they traveling? What's the emissions associated with that? Obviously, if you're an urban office, it's probably more likely that people are using public transport or active commuting options compared to maybe more rural or regional areas. One thing I will say about employee commuting is that if you're calculating emissions for that category, it is essential. It's mandatory with the standards for you to account for the transport emissions from your employees coming to and from the office. For hybrid working, you can account for those emissions, but it's optional for you to include it into that category if you want. So because hybrid working has become more common in recent years since COVID, a lot of companies have started to calculate hybrid emissions for their employees as well, which would be the energy emissions associated with their employees working from home, basically. And you can choose to calculate that and add that into that category if you'd like. If you feel like you would like to track that, or if you'd like to influence your employees and help them to do that more carbon efficiently. But it is an optional thing for you to do within the standard. So yeah, you don't, it's up to the company if they feel that that's a value to them. Upstream lease assets then. So upstream lease assets is essentially this is a bit, so it's essentially energy emissions associated with anything that you rent. A lot of companies will already include this within their scope 1, scope 2. So the official guidance on this is you can include it within this category if you haven't already included it within your scope 1, scope 2. So for example, if you rent an office space, it could be the energy emissions of that office space within here, but most companies would just include that in their scope 1, scope 2 because they would see that within their kind of direct control. Okay, so going into the downstream ones then, so downstream transportation distributions, that's the emissions associated with transporting your product to customer. Processing of sold products, this is if you sell an intermediate product to your customer, what's the emissions associated with them processing that product further. Use of sold products, so that would be if you sell an end product to a customer, what's the lifetime emissions associated with that product when it gets to the customer. So for example, if you sell a laptop to a customer, what's the lifetime energy emissions associated with that customer using that laptop? End of life treatment of sold products. So what happens to that product at its end of life and what's the emissions associated with that? So take, for example, the laptop. Can parts of it be reused? Can parts of it be recycled? Is it going to landfill? So what happens at its end of life, basically, and the emissions there. Downstream lease assets. So if you own any assets that you lease out to someone else, it's the emissions associated with that. So if you're renting an office space or renting cars to a customer, what emissions are associated with them using that asset, basically. Franchises, so very specific to franchises in particular, but it's the energy emissions with it's the scope 1, scope 2 emissions of franchisees. So if you're McDonald's or something like that, it's the energy emissions of each of those individual franchisee restaurants. And then 15 is investments. So this one's particularly important to financial services, but it's all of the emissions associated with all of the investments that you make. And that can be that's quite a broad one for financial services. So that can also include money that you loan out. It can include investments that you make into shares. So it could be quite a broad one as well. So I am conscious that it's a lot of detail, but I do think when we're talking about scope 3, it is important to go through the different categories just so there is an understanding of what each of them is. And hopefully we can answer questions on that as well if anyone had questions that popped up at the end of that. So when we're talking about calculating scope 3 emissions, I suppose one important thing to point out with scope 3 is the challenges in gathering data for scope 3. So whenever you're trying to calculate emissions, regardless of the scope, what your aim that you're trying to do is to try get data as close to primary data as possible. So if we take, for example, a scope 1 emissions of diesel, your primary data on that would be the liters that you consumed within the vehicle. If you can't get that, you move further and further away from primary data, but you try to stay as close to primary data as possible. So in your diesel, with your diesel, what you want is liters of diesel consumed. If you can't get liters of diesel consumed, maybe you say, okay, well, we have maybe the kilometers that the car has traveled within the year. If you don't have kilometers that it's traveled, maybe you say, okay, well, we just maybe have the number of vehicles that we have, and we've just estimated based on an industry average how many kilometers that a car would travel in a year for someone within our sector and of the activity of whatever car that we're doing. So you want to try to stay as close to primary data as possible, but you can move further and further away from it if it's just not possible. And it's important to start with the data that you have. So for scope 3, this is particularly important because in a lot of cases, you're almost never going to get primary data unless you actively kind of build a bit of a engagement program around that. But say, for example, business travel, I think I mentioned this earlier, like you're never going to know the liters that was consumed within the plane that you bought the flight on. But you will know maybe where that person traveled to and how many kilometers it was, and was it business class or economy. So you have to work with whatever data you have, and you can find that over time, and you can move it more towards primary data over time. But it is important just to start with whatever data that you have. So I've listed here the methods of calculations for scope 3, the kind of main ones that are used. Sorry, just take a sip of water there. Yeah, so these are kind of the main ones that are used for scope 3. So, and we'll see kind of pros and cons to each of them. So the first method is spend-based tools. Spend-based tools, how they work is they typically relate emissions data for sectors of spend based on a particular region. So you can get spend data within your organization, and you can use spend-based tools and just input that data in, and it will give you a carbon number kind of related to whatever sector of spend that was in that particular region. They can be developed in a few ways, but that's kind of a general sense of it. The pro of this one is that it's very accessible. So companies haven't been set up to collect environmental data historically, but they have been set up to collect financial data historically. So, but they have been set up to collect financial data historically. So, all companies have that spend data, and they have that kind of euro value data. So it's very easy just to pull that data and be able to put it into a tool. The con with this, though, is that it's a top-down approach, really. So it can be it's not the most accurate method to calculate your emissions for your scope 3, essentially. Like if you think about things that you buy, a company could have, they're also categorized very broadly because they tend to be categorized based on kind of industry level, like maybe the NACE codes or something like that. They'd be quite broad. And a lot of the stuff within your scope 3 might fall within a very few small number of categories, which means the output of your emissions comes out in a few numbers, or it comes out with a few broad categories, which can be, it might not be the most useful for you to try to be able to change your emissions and reduce them over time. Because if you think about it, you could buy something from a supplier, you could change then to a supplier that's more carbon efficient. But if you're using a spend-based model, it doesn't make a difference because you're just basing it on the euro value. And you might even spend more for the supplier that's more carbon efficient. So it might come out within the spend-based tool as if it's higher carbon emissions, which is not the case. So it can be difficult to show improvements over time with the spend-based model, but they are very accessible and they can be useful as a starting point in some cases. The second method then, and this is the most common method overall, but particularly when you're talking about your scope 1 and scope 2, is using emission factors. So this would be emissions per functional unit or per an activity data. So for example, this is an example I've written in here. So emissions per kg of cotton, for example, that you buy, or it could be, for talking about waste, emissions per tons of landfill. So they're developed in quite a lot of ways. Like they could be developed, there's databases out there that can be developed by basically credible organizations. So maybe like for scope 2, for example, SAI have factors, and your scope 3, like DEFRA, the Department of Environment, Food and Rural Affairs have factors that they've developed on a broad number of scope 3 emissions. So the pros of this one is that it's more accurate than a spend-based approach, because you're able to get a bit more granular. It's not going to be kind of industry level categorization. It's going to be based on, like all of your waste, for example, will go into one category in a spend-based, whereas with the emission factors, you can break it down for landfill, recycling, composting. The con of this is that it is going to be a slightly more detailed data collection than a spend-based. That might be more difficult for certain categories of scope 3. And then the other thing just to say is that it is still secondary data. So you might have an emission factor for a certain product that you buy from a supplier that you've gotten from a database, but that might not be your particular supplier's carbon intensity per kg of that product. It's just like, if we take cotton for the example, it might be the carbon intensity of just cotton overall within Europe, whereas your supplier might be a bit better than that. So it is still secondary data. The last method then is direct supplier data. So this is getting emissions directly from your supplier from any goods purchased, or any service purchased as well. So this is the most accurate way to get your emissions. This is basically if your supplier has done their own carbon footprint and they're able to give that information to you. They say, well, we've done this for you, and this is how much emissions that cost us, basically, or that it took us to do that. So it's the most accurate because it's coming directly from the source, and you're able to get all the nuances of your own particular suppliers or service providers. The con of this is that the access to this data may vary depending on your supplier maturity. So yeah, depending on the sector and depending on your individual company, and where they're at in this journey and their suppliers, and maybe countries your suppliers are based. And also the size of your organization as well is something else that factors into it. It can be difficult to get this data from suppliers. Maybe they just haven't calculated their emissions yet and they don't have that data for you. Or maybe it's just difficult for you to get this data from them as well. So most accurate if you can get it, but it can be difficult to actually build that up as well. And you can see here, this is a nice summary, I think, of level of accuracy and relevance of the results versus difficulty of the method. So you can see spend-based, not too difficult. It's kind of just inputting your spend-based data, but the accuracy and the relevance of the output of that is going to be quite low in comparison to direct supplier data, where the level of accuracy is a lot higher, but the difficulty of getting that data from the suppliers can be harder. And then emission factors is somewhere in the middle. But one thing just to say is that a hybrid approach can be used. And I mean that in terms of individual categories within Scope 3 can use different approaches, but also even within categories, you can use a hybrid of approaches. So say for purchase goods and services, people might get direct supplier data from a few big suppliers, use emission factors from big products that they buy or simpler products that they buy, and then they use spend-based just to fill in the gaps. So you can use a hybrid within a category, or you can also use different approaches with each individual category. Like waste emissions, you're probably going to have that data to be able to get to use emission factors. You're going to have tons of where each of them went. And then just a quick one on Scope 3 emissions and the CSRD and the expectations there, essentially. So with the CSRD, what they're recommending is to calculate your Scope 3 emissions in line with the Greenhouse Gas Protocol standard. And I've put the full name there. So the Greenhouse Gas Protocol has a Scope 3 standard that's additional to their kind of normal accounting standard. And they want you to calculate emissions in line with that, or with the ISO 14064-1. If you're in line with one, you're pretty much in line with the other. What happened is the Greenhouse Gas Protocol one was developed first, and then the ISO one was developed on the back of that. So I wouldn't worry too much semantically about which one you're following, but the Greenhouse Gas Protocol one has a lot more guidance in it and will be more useful to you as a company, and is also free. You can access it free of charge as well, which is useful. So I would recommend looking at that one in particular. But yeah, that's one thing that they've asked. And then with Scope 3, they want companies to conduct what they call, what we would call a Scope 3 screening, which is firstly looking at the 15 categories within Scope 3 and identify which ones are relevant to you. So no matter magnitude-wise, just which ones of those 15 categories do you have emissions from? Like if you don't have franchises is immediately irrelevant. But then there might be other categories that when you think about it, oh, actually, we do have emissions from this source or this source. We just hadn't really thought about because we don't think it would be material. But no matter if you think it's material or not, identify which of the 15 categories is relevant to you. And for a lot of companies, maybe it might be a case of, 8 to 10 is relevant. And then of those 8 to 10, a smaller number is actually significant, but just identify what's relevant first. And they also want you to include a list of everything that you think is relevant, and also what's not relevant and why you think it's not relevant. Estimate figures for all relevant categories. So if you've identified 8 that you have emissions from, try estimate some figure for it, even if it's really high level, if it's really ballpark, if it's very back of the envelope, get some kind of estimation on each of those figures so that you can then see the magnitude of each individual category for your company, and you'll be able to then identify which one of those are significant. So you do those kind of high level figures, and then you might say, okay, we have 4 categories here that are completely dwarfing everything else. So these ones are the ones that we would deem significant. And then of the ones that are significant, refine those calculations a bit further. So if you've done a really high level back of the envelope exercise, try basically refine them and get them into calculations that you can really stand behind, I suppose. It recommends you review your calculation methodology every 3 years. So you can review it as often as you want. You can do it before that, but it's just kind of put a placeholder in to say, you know, every 3 years' time, stuff has probably moved on. There's probably more accurate factors out there, methodologies out there. So it's a good point to kind of review and look and say, are we doing it the best that we can? And they also want you to report the percentage of your emissions that come directly from suppliers. So if you've asked your suppliers directly for emissions data, and maybe that comes to 2% of your footprint overall, or maybe it comes to 40%, they want you to report that figure. But one thing I will say is that the SRS standard on climate change does recognize that scope 3 emissions is going to be a combination of estimated and actual emissions. So there is more flexibility around scope 3, and there is more understanding that scope 3 is a challenge for companies as well. Yeah, but one thing I would say is just don't be intimidated about starting. Like, no matter where you start with scope 3, start somewhere. Get some figures, even if it's really high level. Just start on the exercise and you can refine it over time. There is a lot of understanding and flexibility around scope 3. And once you're transparent about what you're doing and transparent about where you're at, it's very hard to fault a company that's trying, basically. So yeah. This is just, I'll race through this because I know we want to leave time for questions, but this is just a last slide I have here, and it's basically about scope 3 targets. Because scope 3, as you've seen, is a bit more of a challenge to calculate and get a grip on, companies often deal with scope 3 targets a bit differently than their scope 1, scope 2 targets. So this is an example just from P&G and how they've dealt with their emissions. So they have the net zero transition plan. Within their scope 1, scope 2, they've got quite stringent targets on that. So they have an absolute reduction target of 63% by 2030 from a 2015 baseline. So that's quite a good absolute target. Their scope 3, then they split into 2 different categories. So what we contribute and then what we influence. So what we contribute is scope 3 categories that they have a bit more control over. So that would be their purchased goods and services, the stuff that they buy, and then also their third-party transportation distribution. And they've set targets around that as well, but they've set an intensity target for both of them. So for the purchased goods and services, 40% per unit of production reduction by 2030. And for transportation, it's 50% per ton kilometer by 2030 as well. And that's not uncommon that companies will do that they'll have a slightly more, that they're stricter, I suppose, on their scope 1, scope 2 targets than they would be on their scope 3, because their scope 3 is a bit more of a challenge for them. And then there's other categories in scope 3, like say, for example, the indirect emissions from someone using their detergent within a washing machine. So they're not selling the washing machine that uses the electricity, they're selling the soap that someone then puts into a washing machine that was bought by someone else, and there's energy associated with them using that. So it's not that they're ignoring that, they have included like a strategy and plans and initiatives that they're going to do within their plan to tackle it. But because it's a few steps away from them, they've set more softer targets for that. So they don't have specific kind of number targets. They more have, here's our engagement strategies around that. But that's just a quick example of maybe how one company has dealt with their scope 3 targets. And it's not unusual to kind of for companies to set different targets for their scope 3 than they would for their scope 1 and scope 2. Okay. Perfect. So we have a bit of time for questions. I hope that it didn't go too much over there.
No, all good, Gráinne. Thank you so much for that very insightful session. We've got quite a few questions there, so I'm just going to go sequentially. Okay, so we've got one from Katrina, who's just asking around double accounting. So for instance, scope 3 emissions, be it upstream or downstream, are not captured by the various associated third parties as their scope 1 emissions. So for example, if it's a construction material purchased, the emissions that are associated with the manufacturing may be captured as scope 1 by the supplier. The transportation of the materials, again, may be captured as scope 1 by the transporting company. So is there that overlap?
Yeah, so by its very nature, scope 3 is always someone else's scope 1 and scope 2. So there is a complete overlap. What I'd say about this is that corporate carbon accounting is very different to national inventory accounting. So national inventories like Ireland Inc. Countries are very clear on we don't double account. We very clearly segregate our emissions so that we're not overlapping and not double counting with each other. For corporate accounting, the attitude towards it is it's whatever you influence of whatever you have any kind of influence over. So double 3 is by its very nature a double account, but that's how the corporate accounting standards are set up. It's whatever you have influence over is seen as kind of semi within your control. And that's how you're able to get direct data from suppliers because it's their scope 1, scope 2. So they're able to have that kind of more primary data on it and calculate it.
Yeah, perfect. We actually have a couple of questions around just direct supplier data as well. How credible is the information that's given by suppliers, and how is it validated for accuracy?
Yeah, so this is a bit of a challenge in itself. There is the ISO 14064-1 standard. There is also verification standards around that. So there's a ISO 14064-3, so they can get actual third-party verification of their emissions, or if it's product footprint as well, they can also get verification around that, or EPDs. So they could get that external verification and then provide you with proof of that. Some platforms as well, I'm trying to think of a few examples, but some of them say if you're using I'm trying to think of an example of one like EcoVadis or CDP or one of those kind of online platforms that request data directly from suppliers. Not all of them, but some of them will do a bit of a check as well on the emissions data that comes back, but not all of them. So we definitely check that with any provider before you do it. But it is a little bit of a challenge. And I think there is a piece of, if you're asking data from suppliers, having the person within the company will probably have to do a bit of a quality control on it, particularly in the first couple instances, and then feedback to your suppliers any issues you might see in the data as well. But yeah, there is no kind of hard and fast rule. It is kind of, yeah, how do you know someone's footprint is correct? Basically, it's the same way that you might know your own footprint is correct.
Absolutely. I think it just goes back to just ensuring there's transparency in your efforts.
Yes.
There's another one from Jacqueline asking, do we have to calculate emissions from all of our suppliers, even if they are between, say, 50 to 100 suppliers?
So technically you're supposed to include everything, but what a lot of companies will do is like there's probably that 80-20 rule. So probably 20% of your suppliers is 80% of your spend. So you might just focus on them, or might focus on 20% of your top products is 80% of your impact. So you might just focus on the bigger impact ones in a more detail, and then for the other ones, maybe just fill in the gaps, or maybe do a more longer kind of engagement approach to them. But you could always get a certain portion of your supplier's data and then just extrapolate out for your whole footprint in the short term, and then just work to refine that over time.
Fair enough. Another question just around, we rent out pubs, so do we need to collect data from the landlord?
You rent your pubs, is it?
Yes, that's the question.
Yeah, so technically you can either include that. A lot of companies will include that in their scope 1, scope 2. So it would be good to get the energy data from your landlord to be able to calculate that. You could, technically speaking, include it in your scope 3 in that upstream lease assets as a part of a category. If you feel like we're very overwhelmed, we can't get the data off the landlord, he's not answering us, we don't think we have any control over it, you could put it in there, but I would maybe try including your scope 1 and scope 2 if you can, and get that data off your supplier.
Perfect. And we've got another one. We install thermal insulation, so can that be offset against our submissions?
Which insulation is
it? Thermal.
Oh, okay. So you can't, it's not necessarily that you can offset it, but if you get the baseline before you installed that insulation, you'll be able to see the reduction from before and after. But you can't technically say, well, we think it's saving this much and minus it off your footprint. It has to be kind of, here was the baseline, here's the after, and you can see the reduction.
Yeah.
So you're trying to calculate real-time emissions essentially, rather than minusing off anything.
Perfect. Okay, so we're actually just a minute over our scheduled time. So if there aren't any more questions, we can wrap up this session. Thank you so much, Grania. That was extremely insightful, and I'm sure everyone who was on the webinar today has gained a lot of valuable insights. So thank you so much. And of course, thank you everyone for joining us for today's session. If you wish to learn more about sustainability, Scope 3 emissions, decarbonization in depth, do visit the ISS website. um, Explore the Diploma in Business Sustainability course, which is designed to provide you with sort of the right tools and templates to get you started on your path to sustainable business practices. And we'll be holding many more such webinars on issues of topical sustainability importance in the future. So keep an eye out on our website, on our LinkedIn for future dates for these sessions. And I look forward to seeing many of you there. And yes, so thank you, everyone. Thanks so much. Thanks,
Thank
Rania,
you.
again.
Thanks, everyone.